Good day, I'm Chartered, your accounting tutor. In today's class and video, we are still going on end of accounting period adjustment. End of accounting period adjustment. Today, we are looking at one of the adjustments that learners find it very difficult to handle. It is not just common, except you are giving more clarity to it. And I promise to give you justice to try to explain what the adjustment is all about and how it is handled in financial statements. Number, we are talking about allowances for expected credit losses. Allowances for expected credit losses. What is formerly called provision for bad and doubtful debts. What is called, this is a new name based on International Financial Reporting Standard. But initially, what most learners knew is what is called provision for bad and doubtful debts. So let's look at what you understand by provision for bad and doubtful debts, which is allowance for expected credit losses, the new name. This is the amount of money that is set aside after the profit realized by the business for the purpose of providing for debts owed by a customer going bad in the future, but for which the amount cannot be calculated with substantial accuracy, and the organization is uncertain as to the amount and date it will arise. It will arise. Provision for bad debts or allowances for expected credit losses. What do we mean by this? By way of explanation, I want to tell you that provisions are made in respect of debts that are owned by customers. They are made in respect of debts that are owned by customers. Customers own debts based on goods sold on debt on credit. But in the process of payment, the behavior or the way customers pay, either slowly or whatsoever, or they keep on paying year in, year out. Most of them cannot pay the debts in 1 year, and the debt keep on overlapping from 1 year to another, some even 3 or 4 years, they keep on paying. So it becomes doubtful that whether the debts will be collected or not. As the years passes, you discover that you have such debt, you have what is called balances brought down in each of the debtors' account. Only few debtors end up paying their debts. So because of this, organization feel that there should be a provision that will take care of the expected losses that might come if the debtors or the customer are not able to pay all the debts. And that's the meaning. They will set money aside in case the debts are not collected. The debts are not collected. Not that they must go bad, but the expectation that they will go bad is also high because based on previous year experience, most of these debts at the end of the day are not collected. And at the end of the day, you discover that the business will have a reduction in profit. For example, you're expecting to get a profit of 10,000. And if these debts go bad, they will reduce your expected income. So this provision allowance is set aside that in case debtors will not able to pay all their debts, then the business will not suffer because the amount has already been created that they might not pay. So it not create any shock to the business because they already made provision for it. And that is why I say we're expecting that something will lose, and that's why the new name. So in this case, what are the common types we have in accounting? The common type of debts, and these debts are realized, just like I said, based on previous experience, based on calculation. The business discovered to create certain percentage that these are the amount expecting as losses. For example, if last year debts, for example, is 20,000, the one that were able to collect it, plus the current year, which is like 40,000, and like that. So if the business want to get a percentage, they will divide these to be able to get a certain percentage that they will set aside that this year we're expecting that amount will not be collected from debtors. So this is based on previous experience of debts not being collected. Altogether, the average will be taken to be arrived at a percentage or a given amount that the business will be setting aside that they might not be collected from their customers. So that is how the percentages or the amount of expected credit losses are created by the business. Let's look at the types that we have commonly in adjustment or in accounting. Number one, we have what is called the initial allowances during the accounting period found in the trial balance. This is the initial allowances that the business expects as the business is going on, as they are receiving money from customers. They are looking at the way the money is being received from customers. So they decide to based on how their money is collected, they decide that a certain amount during the year might not be collected from customers. And that will pass through the double entry process and will be found in the trial balance. Or sometimes it will be based on the previous year amount that was expected not to be collected that will be brought forward. So the initial allowance during the year or accounting period is normally found in the trial balance. As you can see, allowance for credit losses, or what is called provision for bad debts. You will see it in the credit side. It's the credit side because it is looked as revenue. Because the business have not yet lost the money, but they have set the money aside. So it's like the revenue. It's like the money that the business is expecting to earn, but though they are not set. It's not expenses yet. It looks like revenue. That's why it's the credit side. 2,000 is expected to be missed or lost, but it have not lost yet, and that's why it's put in the credit side. Then this one is account receivable, which will be there. Let's look at the second one. The second one is allowances at the end of the accounting period found in additional information. The initial one is given in the trial balance, while another one is given via the additional information, as you can see. If you come down the additional information, these are the allowances. Though I have up to 4 years because I want to give different scenarios that learners can find in questions or examiners give. So I'm going to explain how if it is given in this way, you handle it this way. If it's given based on this scenario, you handle it, and all these. These are the common way learners normally see in the additional information, and they try to battle with it. So I want to give justice by explaining each of them. If it is like this, you do this way. So like this, you do this way with full explanation. So that anyone you're able to see, either in the real life situation or in past questions or anywhere, you can handle it. Let's go back. Now, the allowances that you see there, these are the ones that are found in additional information. What do you mean by this? These are the allowances that are created at the end of the accounting period. This one is the initial one, based on what has been happening in the previous year. Now, in the current year, which I've just ended, based on the collection from the beginning of the year to the end, the narration might change. Maybe the business feel that maybe only 2,000 or 3,000 might be lost from credit amount received from customers. But at the year end, the business might look at the real nature because the year have already ended. What has been collected and what is expected to lose. They will try to either increase it or reduce it. That is why, in most instances, the one that is the allowances created initially in the trial balance is also different with that in the additional information, because this was the narration in the beginning of the year of the previous year, while this one is the current expectation at the end of the accounting year end, and the business is about to prepare its books of accounts, the financial statement. So they will now create another allowance, trying to be either saying that the amount will either increase or reduce as the case may be, or they will maintain it as the case may be. So this one is not found in additional information, while this is the initial one found in the trial balance based on the experience. So this one is the initial allowance, while this is the allowance at the end of accounting period based on the nature of collection the business have witnessed till the end of the year. Let's see how we are going to treat the allowances one after another. The first one is allowances for credit losses made up to 20%. Made up to 20%. Let's see, look at how we handle that. Take it that this is the initial allowance already set in question, given in the trial balance, which is 2,000. Coming down the additional information, the question now says that allowances for credit losses is made up to 20%. It means you have to calculate 20% of, and mind you, allowances are made based on account receivable, which is the credit sales made from customers and customers are owing. So you always base it on account receivable, whether informed or not. Take it that allowances for credit losses is always on account receivable. So whether they mention or not, always use it to calculate your allowances. So here they are saying allowances for credit losses is made up to 20%. That is 20% of account receivable. Come back and let's work it out here. You now say that end of accounting period allowance, which is given in percentage, you want to convert it into a real amount. So if you want 20% of 20,000 of the account receivable, you are going to have 4,000. So 4,000 become the end of accounting period allowance, which is different from the one that was created in the current year or during the year or initial year. So here you now put it out. You now say the new allowances, which is 4,000 calculated, which is 20% of this. Then you go and pick the one given in the trial balance, which is 2,000, which is the initial one, and come and make your deduction. When you deduct these 4,000, deduct 2,000 from 4,000, you are going to have 2,000. This 2,000 become an increase. Why? Because the initial one was 2,000 and the current one is 4,000. I should tell you that based on the nature of the collection, the allowance have increased from 4,000 to 2,000 and the increase become 2,000. Mind you, it is this increase that is treated as operating expenses, not the initial or the end of accounting period. No, it is the increase. The increase because the initial was 2,000, the current was 4,000. There's an increase by 2,000. It's a 2,000 that is expected to be an operating. That's what the business is expecting to lose for the current year is 2,000. So the 2,000 we use as an operating expenses under the income statement. As I come to stage it, you will see how I'll present it as an operating expenses under profit or loss. Let's look at the second scenario. The second scenario, we are treating the same thing, but look at the language. The emphasis is the language on how the examiner will present it. The first one is clear. Let's look at the second one. Allowances for credit losses is 3,000. Here, it was given a percentage. We're able to convert the percent to get 4,000. But here, the examiner will not hide it, or the question will make it straight that allowances for credit losses is 3,000. But all we know is that we are not going to calculate any percentage. Here is straightforward. It's just for you to make a comparison between the initial allowance and the new allowance. So you just pick the new allowance in the additional information is mentioned as 3,000. Bring it out, then pick the initial allowance which was already given or done in the initial during the year or the previous year, which is 2,000. So if you pick the 2,000 and then subtract from the new allowance of 3,000, which is given directly by the question, then you get a difference of 1,000. Here too, it is clear that the difference is an increase. It's an increase. Anytime it's an increase, you treat it as an operating expense because the business is expected to lose 1,000. So the expectation of missing 1,000 become an expenses. So you now say 3,000 minus 2,000, you get an increase of 1,000. So 1,000 will be treated as an operating expenses under profit or loss statement. And let's go to the next one, which is the third scenario. It can also be given in this way, whereby you now say allowances for credit losses should be increased by. Underline this word and understand the statement. It should be increased by 500. It means that here we are saying that the initial allowance based on the language, if something is increased by, it means you are adding. It means initially it was 2,000. So if it is increasing by 500, means you are adding 500 to 2,000 to be able to get the new or the end of accounting period allowance. So here, look at how we present it. We now say that the new allowance was 2,000 during the year or in the previous year, plus the buy. Look at buy means addition. It increased by 500. If I add 500 to 2,000, you get 2,500. So here, the new allowance created at the end of the accounting period is 2,500. Though you cannot see it anywhere, but the language by means 2,500 added to the initial one 2,000 will give you 2,500. This becomes the new allowance. So by the time you deduct the initial allowance of 2,000, which is already given in the trial balance, you get 500. This 500 is also an increase. Already they said increase by. It's an increase. So anytime it's an increase, then it means you are going to treat it as an operating expenses. Mind you, any increase in allowance from the initial and the current one is treated as an operating expenses under profit or loss statement. Let's look at the last scenario. In the last scenario, here we are saying reduction for credit losses is up to 5,000. That it is reduced by, to 5,000, 5%, to say. The reduction for credit losses is up to 5%. That means here you are going to create a scenario by working out 5% of the account receivable. Let's see how we work it out here clear. You now say the new allowances is 5% of 20,000. So 5% of 20,000 is 1,000, meaning it has come down, meaning based on the way customers are paying, there's tendency that the losses will not be as up to 20,000. Sorry, up to 2,000, mean to say. So it means it will come down. And that is why if you work 5% of the account receivable of 20,000, the amount will be 1,000, meaning there is a reduction in the allowances that the business is expecting to lose from amount collected from customers. So if you work it out, it's going to have 2,000. The initial one is 2,000. Then you discover that the new one is less than the initial one. So when you deduct, you have 1,000 naira. So 1,000 has become a decrease. So this decrease here become income. The decrease become income. Just like you are expecting to lose 2,000 naira initially, but now you have lost 1,000. So in this case, it means you have gained back 1,000 naira, which become income. In this scenario, it's still going to be used under profit or loss, but it's going to be added to gross profit, which is other income. It's going to be treated as other income. While the other increase are treated as operating expenses, this is treated as income added to income. And at this point too, I want to clarify how these allowances are used accordingly. The allowances are given in 4 scenarios. Number 1, if expected losses are given in the trial balance alone, get me right, that's the situation whereby you found allowances for credit losses given only in the trial balance. How do you treat it? If allowance is given only in the trial balance, this is treated as revenue. It's treated as revenue. That is rather income, I need to say. And it is added to gross profit. It's added to gross profit. It's a situation, get me right, a situation whereby you see a question and the allowances is given only in the trial balance, pick it and add it to gross profit as other income. That is the first scenario. The second scenario is a situation whereby you have allowances found in the trial balance, just like the one I'm giving you my question illustration here, found in the trial balance and also found in the additional information. Here there are 2. So if there are 2, as you can see as my illustration demonstrates, what you're going to do is that you must find the difference. You must find the difference between the initial and the current allowance. So the difference between the initial and the end of country period must result into something. It can either result into an increase or a decrease. If it's an increase, mind you, the increase, you are going to treat it as an operating expenses. But if it's a reduction at the last scenario, you are going to add it as other income. That's the second scenario you can see probably. If there are 2, you must find a difference. And it's a difference that is either expense or an income added on the other one income. Let's look at the third case. In the third case, it's a situation whereby you can find allowances for credit losses given only in the additional information. That is, you will not see any allowance in the trial balance. This will not be found. But coming down the additional information, you will see allowances given in the additional information. In that case, there's no comparison because you don't have the one in the initial year, the trial balance, but you are seeing only allowances in the additional information. Mind you here, if you are able to calculate it or you pick it direct, use it as an operating expenses. Because here there is no initial one for you to do comparison. So as you pick it, either by working the percentage or pick the amount direct, mind you are going to pick it and use it direct as an operating expenses under profit or loss statement. That is the idea. So now it is clear that is how allowances are given. You can either see it only in the trial balance or only in the additional information, or you can see it both in the trial balance and the additional information. And if you follow me, or you'll be able to handle it according as I demonstrate that one that is found both in the trial balance and in the additional information. Don't forget to like my video, comment and share. Anything I've explained and you're not clear, come back down the comment section. Comment, ask any question. I will come back and see, give more clarity and explain it in the lowest level that you'll be able to understand. Like my video, share, because this is one of the most confusing or difficult areas that learners keep on asking. How do you handle this? How do you handle this? So with this video, go ahead, go over it, and then if you have any challenge, give your comment, share the video to those that are having challenges to handle this type of adjustment. I will come back and still explain. Like and comment. I remain your accounting tutor, Chartered. See you in the next class. I'll continue how we are going to see how these allowances are presented in the profit or loss statement and also in the statement of financial position. Don't forget to always follow my video, because more is going to come as I explain the illustration and later solve a very comprehensive question that will carry almost all the adjustments I'm trying to treat. Thank you, and remain Chartered.